Well, look at that. There is a lot of red across the stock market at the moment, and the continuation of the fear carries on through the stock market. You look at the heat map, look at the amount of stocks that were down, and it's not just the smaller market caps. We're actually starting to get some of the big dogs come down. You look at Microsoft down, you look at Apple down, Amazon down 4%. It was an ugly day yesterday in the stock market, and you can see here now on the S&P 500, the S&P is starting to pull back a bit of a bigger way now. We are down, if I go from the peak, actually that's not from the peak, from July time, the S&P is actually down 6.7%, so we are very close to actually entering a correction territory. But the crazy thing is that I still look at the S&P 600, the small caps, and I actually used this example with the Russell the other day, and I said the S&P 600 and the Russell are moving very much in line at the moment. So I thought actually today I'm going to use the S&P 600, and I mean look at the S&P 600. I mean that was still down. The S&P was down yesterday 1.47%, which is still a pretty decent amount, but the S&P 600 was down exactly the same, which is, I still think, is unbelievable, because you look at the valuation the S&P 600 is trading at the moment. It's historically one of the cheapest valuations it's ever traded at. The S&P, on the other hand, is one of the 500 is one of the highest it's ever traded at. But yet the S&P 600 is still getting dragged down the same amount, or even more. If you actually look at the S&P 600, that's actually been, since July time, that's actually been dragged down. That's in a correction. That's in 11.5%. It's dragged down more than the S&P 500. Now, normally that does happen in the small caps. They are a lot more volatile. When they go up, the small caps normally go up more. When it goes down, the small caps normally do go down more. But the difference is that the S&P 500 is really high valuation, one of the highest it's ever been, and the S&P 600 is one of the lowest it's ever been. It's a mega disconnect that's going on. I mean, year to date, the S&P 600 is actually negative 1.8% now. And it's unbelievable. Like I said before, I'm not an index guy, but I do look at the S&P 600 as being a little bit interesting at the moment. But hey, now obviously this all comes off Jerome Powell. Jerome Powell has caused all of this, and it's been a major concern that I've been putting on the YouTube channel in the last few months. I've said, look, I'm worried about this. I think that this is going to cause major issues for the stock market, and I need to build a cash pile, and I've been trying to build up a cash pile. I didn't think it would happen this quick, so I've not built as big as cash pile as I would like, and now that I've seen a lot of opportunities out there now, so it's already like starting to dip into those opportunities and buy them. But obviously this is all caused by Jerome Powell. Jerome Powell should have, as I said, 3-4 months ago, should not put up interest rates anymore. Inflation is down. The only thing that is up is lagging indicators. They carried on putting interest rates up, and it's now causing the economy to slow down. You're seeing investors, you're seeing Wall Street going, look, we don't like what you're saying. It's going to eventually cause a recession in the economy. Stocks are pricing towards recession now. Wall Street have gone, right, that's it. We're pulling out the stock market because Jerome Powell is doing the wrong thing. This is all caused by Jerome Powell, and like I said, we called it out on the channel a few months ago, and it's all coming true now. And I didn't think it would happen just yet. I thought we'd see the start of it in 2024, but obviously we're starting to see the pain of it right now. But obviously not good, but it is creating a lot of opportunities. Now, what I will say is actually yesterday, even though the S&P was down 1.5%, let's call it, the S&P 600 was down 1.5%, I actually had a pretty good day in the stock market, and it was because of this guy, the King. The King actually had a good day. It was actually up a little bit more than this. It was actually up pre-market 5%. And obviously being a bigger weighting in my portfolio, this kind of made it okay that DraftKings was having a really good day. And I'm actually surprised that the market's been dragging down, and DraftKings has actually been relatively holding up okay at the moment, which has been the really surprising thing. But JP Morgan came out, they upgrade DraftKings, and I've got to say, it upgrades DraftKings after rallying 150%. And it's like, where were you? Like, I remember DraftKings being, $10 at the start of the year. Where were all these people that were bullish on it? I remember, I am pretty sure I was the only person that, obviously some of you guys are watching the video, but that talks publicly or has a platform to speak. I saw not a single YouTuber, I believe, coming out and saying DraftKings is a good opportunity. I remember no analyst at all coming out and saying positive things about DraftKings. And now the stock is up 150%. They all come out and go, oh yeah, it's a good stock. It's crazy. But it is what it is. Analysts chase share prices. When the stocks are up, they're all changing up the forecast. When the stocks are down, they're all saying it's a really bad stock. But, the other thing is that it's worth saying that if we are going to see the negative sentiment come back, if I am going to get the options to buy DraftKings at $10 again, I'm once again going to take that opportunity. And there was other crazy things that were happening in the last couple of days. I mean, Card Factory. Did any of you guys see Card Factory bring out their trading update? Card Factory brought the trading update, and the stock actually created massively on the trading updates, down 14%. Now today it is worth pointing out that it has had a little bit of a bounce, it has given something back, but it just shows you like this stock was down massive on their update. And if you guys have ever, if you go and read their actual report that they brought out, their interim results, absolutely fantastic. The company was up 11.5%. They're paying down the debt. The profitability is going up. They're still forecast to bring out the dividend in 2024, which is only a few months away. I think a few people have actually read that wrong. Like, they don't realise that financial year 2025 will actually be in 2024. So, we're very close to getting the dividend away. Balance sheet's getting better. The debt's coming down more and more. And this company's, growing profit amazingly, revenue up amazing. I don't know if online sales were what people are looking at and going, it's down 13%, but it only makes up 1% of the revenue, so it's not that big of a deal. And I look at Card Factory, I thought these were stellar earnings. For a company that's trading at 8 times earnings, these were fantastic. And the stock dipping on this, I was like, it's where we are in the market at the moment. It's crazy that we're seeing these opportunities come out. I saw AlphaWave. AlphaWave came out and they brought out their update, and they were pretty solid, but the stock's down 21% since that time frame. And actually, Jefferies came out and actually said it was 100% upside they see. Now, obviously, if they didn't stick this behind the paywall, it might have given the stock a little bit of a lift here. But, this company came out and the results were on fire. The only problem is that they dipped into a loss at the first part of the year, but they're actually going to get to profitability in the second part of the year. And the market just, threw them out. It seems like the market at the moment is so focused on profitability. And even sometimes when the companies are bringing out profitability, they're still driving in the market, they're still driving it down because the negative sentiment's coming back again. I was seeing the other day, I did a video on Etsy yesterday, and somebody's out saying Etsy's going to go to $5. Like, I've not seen comments like that for a long time. I know. I remember seeing the likes when, Hims was at $3 and people were saying, oh, it's not a buy. I remember people coming out on, DraftKings when it was at $10 and saying, oh, it's absolute terrible, it's off bankrupt. And obviously, then it went up to, rally, 150%. I've not seen this fear for a long time in the stock market, and it gets me excited because when I start seeing these fear, this is the best time to be invested. This is where the opportunities start coming out, and they're starting to appear again. Obviously, DraftKings isn't at that time like it was, but there's other stock. Hims is an example that's starting to show them opportunities again, and it's exciting. It's exciting to see these opportunities. You move out what fear is out there, and the people that are getting sucked in by the share price movements. And if you guys that were buying in 2022, even though it was a shorter rally, I'm sure many of you guys that were buying DraftKings in $10 saw the returns. I'm sure you guys that were buying Hims at $3 saw the returns. So it's exciting to see these opportunities start coming out again, because I thought we might not see these opportunities again, but we are. And AlphaWave, down 21%. And once again, the company reported, royalties and silicon was up. They did 113 million. Revenue up 228%. It's absolutely crazy. And like Etsy, I'd made the video about Etsy the other day, and it's great to see there's the fear around it. And I said, if I can get this in the $50 range, that would be really interesting when it does start getting there. And we're seeing Etsy now pushes into the $61 range. It's very close to getting to that 50 range. Yesterday it dropped 4% alone. And you're starting to see these opportunities out there. Enphase, I've got to start doing some research on Enphase because this is looking very, very tempting. Like you look at Etsy at the moment. Etsy is one of those stocks that's getting absolutely punished. I actually saw someone yesterday say, oh, it's a loss-making business. Not actually realising it was a one-time charge that's not actually a loss. And that's the fear that's around there, and not realising that actually, oh, that's Enphase actually. Where's Etsy's? Etsy's at 16 times earnings. It's absolutely crazy. I was saying Enphase. Enphase was one of the most popular stocks out there, and now because the interest rates are starting to hit it a little bit, it's starting to have a little bit of slowdown. It's had that big boom from the solar energy explosion. You look at it, Enphase now, that was only nearly this year, only a year ago, a $336 stock, down 64%, and it's, solar's going to be massive in the next few years. This company's still going to smash it in the next 5-10 years, and yet you're getting this company now trading down at 18 times forward earnings. I'm really struggling for time at the moment, but this weekend I've got to sit down and have a look at this stock because this looks, a really, really interesting opportunity. Adyen, I've never been a fan of this one because I thought it was a bit overvalued. But then, out of nowhere, this stock from 2021 has a dip, starts rallying up in 2023, and in the last kind of couple of months, the stock's fallen 56% within a month. Adyen's fallen 50%, and I've got to say, now this, when you look at this thinking, is this an opportunity here in Adyen? Look at other consumers. This is what I'm saying. There's so many stocks now that are getting recession priced into them. You're looking at Nike. I mean, Nike is one of the highest quality businesses out there, but it's consumer orientated, and people are thinking, oh, is a recession coming? And people are throwing down Nike for half the share price where it was from a year ago. It's quite an interest that those opportunities are going to happen. And I'm looking at something like Celsius, and I really would love to get into Celsius, and thinking, is the fear going to start building up into this one? We're starting to see this one drop a little bit. This is already down 18%. We get a little bit longer, this has opportunities, but there's so many opportunities that are being created out there. They're starting to get the big tech that's starting to sell off. You're starting getting the opportunities in them again. The big thing is, what I can't believe is the S&P 600. I can't believe that we're seeing these stocks that were already at historical low valuations going historical lower. That's the really interesting thing. I should have thrown InMode on this video. InMode is a very high quality stock, and I mean, that stock, I think I was up 80% 2 weeks ago on that stock, and now I'm up like 40-50%. It's been absolutely devastating. I said, I won't buy InMode unless it goes a lot lower, and within a week, with the fear being there, it's got there, and I'm like, I'm probably going to have to buy some InMode there. Like Card Factory. I was seeing Card Factory the other day, bring out fantastic earnings, 10 out of 10 earnings, and yet the stock's dipping 14%. And what's getting is that the fear of, recession getting priced into that, or are people just really picking on negatives? Are people looking at Card Factory going, oh, well, the dividend isn't back yet, without realising, well, they're going to be that dividend's going to be back within 6 months. Or they're focusing on, online sales a little bit weak, so we're going to sell it off. Well, not when it makes only 1% of your revenue. Another one is S4 Capital. Marketing company, recession, not good, we're going to sell it off. But as I was saying the other day, and obviously, I had Martin Sorrell on, which was absolutely amazing. But, you looked at that one, and it's a 373 million market cap. If S4 Capital do the profitability they're forecast to do, they're going to do about 100 million in free cash flow. They're going to be they're going to be trading around 3 times free cash flow. You're going to have a company that's, potentially does about 50 million profitability. You're going to have a company that's trading at like 7 times earnings. Yeah, we might be going through a recession, but should we be this low? There's opportunities out there. I could have stopped. I should have thrown Topgolf in here. Once again, people thinking, people aren't going to go do golf, in a recession environment. Look at Topgolf and how much that's been thrown down at the moment. It's crazy. It's crazy. And the crazy thing, like I said, is seeing that the big tech is coming down, but how low now? You've got so many stocks at historical low valuations again. And like I said, if any of you guys were buying during the fear of 2022, you probably did very well, and that's only one good year. You imagine when we get into a bull market, and we have 3 or 4 years of a good bull market. Imagine how good some of these stocks at these top levels are going to look as really good opportunities in a few years' time. You're going to be looking at them going, you'd be in 2026, 2027, and going, do you remember in 2023 when the Fed went a little bit too long or too high on their interest rates, and there was a bit of inflation, and even though inflation was coming down, everybody was making a big deal because it was a lagging indicator, and we had all those opportunities, opportunities where they were trading at the historical low valuations. It's crazy. There's crazy opportunities out there, guys. So, make sure you take advantage of it. And if you're on the Patreon, I did drop an exclusive video on there, which was the DS Smith video, which was voted for on the stock request. So we had a look at DS Smith, and we talk about when potentially I could buy DS Smith on there, and that's the exclusive video on Patreon. So if you do want to join, that link's in the description, only £5 a month. Hope you enjoyed the video anyway, guys. My thoughts on it out there. There's opportunities out there now starting to be created. It's looking like the time to start taking advantage of them again. Hope you enjoy it. See you in a bit.